Ladies and gentlemen, welcome back to another episode. This week is going to be huge for markets. We have a ton of economic data as well as massive earnings. And I do want to share with you what Tom Lee said about this market following the Fed on Friday. I think Jerome Powell was a gift that is going to keep on giving to this market. Ladies and gentlemen, hit that like button and subscribe to the channel if you have not done so already. Check out that link down below in the description of this video if you are trying to come invest in potential large winners in the small cap AI field. Essentially, what we're doing is going out, finding the small cap AI stocks before they explode into quote unquote household names like BBAI, SoundHound, some of the other data center names like a CoreWeave, for an example. We're trying to invest in those before those moments happen to really get those outsized returns while also investing in high quality companies. The fact of the matter is, if you want a 10, 20, 30x return, a lot of the times you have to take on a lot of risk, and a lot of those companies are dog shit. We're trying to find the good ones that just Wall Street doesn't know about yet. There's one stock in particular I have $100,000 invested in, a little bit more than that at this point. And I think it's going to be a big winner, not a recommendation. I'm not a financial advisor. Come to your own conclusions. Read the disclaimers, okay? Contact a financial advisor before making an investment decision, always. But with that said, let's get into today's episode. Now, in broader market news today, Canada's Prime Minister says he would not rule out a presence of Canadian troops in Ukraine as part of a future security guarantee. Now, in the news today as well, the Pentagon has quietly blocked Ukraine's long-range missile strikes on Russia. Zelensky, responding to questions about reports that the U.S. has revoked permission for strikes in Russia, says Ukraine has lately been using its own weapons to hit Russia and does not consult on this with Washington. Russia today also proposed a 146 for 146 prisoner of war swap with Ukraine, or POW swap. The Pentagon is preparing to send National Guard troops to Chicago, according to the Washington Post report. So, according to the Washington Post, Donald Trump reportedly weaponized U.S. tariffs to protect corporate allies, pressure foreign governments, and advance political goals far outside of trade policy. And that is actually all of your broader market news in the last 24 hours. There really hasn't been much. It's kind of been a quiet weekend. Now, we have a lot to go over as far as economic data and earnings coming out this week. Now, let's go ahead and get started with your economic data for this upcoming week. It's going to be a huge week. And again, just to reiterate, whether we go into a larger drawdown in markets or not is going to be determined off of the economic data. For an example, if the economic data is weakening, that's not going to be good, right? If recession odds rise, that's not good, okay? That is the growth scare that a lot of people predicted. We'll get into my expectations as we get into these data sets and expectations, but this week's critical for evaluating how strong is the economy. So tomorrow at 8:30 in the morning, you have Chicago Fed National Activity Index. Again, one of these smaller regional data sets, doesn't really move the broader markets. New home sales for July, new home sales month over month. And Dallas Fed Manufacturing Index coming out at 10:30 in the morning. So some smaller data sets starting off the week tomorrow. On Tuesday, you have durable goods orders month over month. Now, this one's going to be important because last month you came in at negative 9.3%. On a month over month basis, you're expecting negative 4%. So that would be a back-to-back really negative reading. Honestly, this is probably set up for a positive surprise. Easily, in my view. Like, to see a negative 9.3% and then a negative 4% on a month over month basis, that would be like really, really bad. Okay. If that's what we're priced for, I think there's an upside surprise potential there. So Tuesday, wouldn't be shocked if that number actually comes in positive and we see a positive reaction in markets. You will also get a speech from Fed Barkin. We see Fed Mausoleum after Powell that kind of flip-flopped a bit from the from the, let's pause, let's wait and see kind of approach to now Fed Mausoleum is like, hey, depending on the jobs report, it may be time to start adjusting the policy rate. Okay, so does Fed Barkin flip-flop as well? We'll see. Okay, Powell could be a big driving force to get others to flip-flop as well. Now, currently, there's an 88% chance of a cut September 17th. You're pricing in another cut for October 29th. In fact, you're pricing in a 46.7% chance of 3 rate cuts by October. So maybe a double rate cut. Okay, kind of wild. And then December 10th, you're pricing in a 3rd rate cut at 47.4%. You technically aren't pricing in a 3rd cut until this gets above 50%. So you're pretty close to pricing in 3 rate cuts this year, at least. And there's actually a 37.8% chance of 4 rate cuts this year. But it just depends on why are we cutting rates? Are we cutting rates because the economy is weakening? That's not good. Are we cutting rates because the economy is doing okay, but inflation is coming down? That would be a good reason to cut rates. Okay, that would be a positive for markets. That would lower recession risks. That would potentially raise corporate earnings and help extend out the time horizon. One of the big things that rate cuts actually do is if you get less on your money risk-free, then you may need to take on more risk. Okay, and what Wall Street does is, let's say Tesla is trading at whatever, 100 times, 200 times 2025 earnings, Wall Street might say, hey, I expect EPS is going to be, call it $5 by 2028. We're going to put a 200 times multiple on that, and that is a reasonable price today to buy Tesla. Okay, so people extend their time horizons out instead of just looking at next year, for an example. Maybe they start to look at 2028 or 2027. Okay, keep that in mind. On Tuesday, you also have the S&P Case-Shiller home price year over year and the CB consumer confidence that comes out at 10 o'clock in the morning. Richmond Fed manufacturing data, Dallas Fed services data, but again, smaller regional data sets do not tend to move markets. On Wednesday, it's actually going to be the slowest day. You do have a 5-year bond auction and another speech from Fed Barkin, but besides that, a pretty slow day. Now, on Thursday, you're going to get the GDP growth rate quarter over quarter second estimate for Q2, expecting GDP to come in at about 3%. But hey, again, we'll see. Last quarter was negative 0.5%. So we are expecting a big rebound there. As long as that holds, that's going to be good. We do have initial jobless claims expected at 236,000. Again, if that comes in too high, that's a negative. If it comes in too, on the low side, that is a positive. And basically what I'm getting at here is good economic data is going to be good for the markets over the next 6 weeks. Bad economic data is going to be bad for the markets over the next 6 weeks, especially during this period of seasonal weakness. Okay. Thursday, you're also going to get the Kansas Fed Composite Index, Kansas Fed Manufacturing Index. Again, a regional data set, not really going to make or break our markets. At 1 p.m. on Thursday, you get a 7-year bond auction. Now, some of these bond auctions could start to be even more important considering the path of rate cuts that we're expecting. Like, for an example, do banks want to buy 7-year bond auctions? If they do, more demand is going to drive up price and lower yield. There's an opposite relationship to price and yield. If people start to buy the bonds, if banks start to buy the bonds and companies and individuals, then the price is going to go up and the yield is going to go down, vice versa. So basically, if people start to buy the bonds, they're expecting lower rates. Okay, if people do not show up to these bond auctions, then they are not really buying the whole Fed's going to cut rates. Inflation is not an issue at this point. So some of those bond auctions could actually be kind of important. Now, on Friday, this is really one of the bigger days. Okay, you have core PCE month over month. You're expecting 0.3%. PPI feeds a lot into PCE. So that high PPI report, if that feeds into PCE, that could be a little bit of a problem coming on Friday. Now, the expectation is kind of high at 0.3% on a 12-month annualized basis. That is 3.6%. So like that's a high number. The risk is if we come in at 0.4, let's say, that's a 4.8% annualized PCE rate. That is way too high. Okay. Now, if we come in at 0.2%, let's say, that's only a 2.4% annualized rate. That is a lot closer to the Fed's target. And that would help really justify rate cuts as well, as PCE is the Fed's preferred gauge of inflation. Now, personal income month over month is expected at 0.4%. You don't want to see this come in too high, okay? Because the argument from tariffs is if tariffs are going to cause lasting inflation, it's because prices go up. Consumers ask for pay raises. Companies give out pay raises. They raise prices again. People ask for pay raises again. Again, the wage price spiral. Okay. So even though it's like there's like a 0% chance or a 1% chance maybe of a wage price spiral, like it's not going to happen. If we do get like a really high personal income month over month gain, Wall Street might get a little bit nervous about that. We know Wall Street's not the brightest. They just put numbers together and create narratives, okay? Even if there's no rhyme or reason to the numbers in the first place. We also get personal spending month over month, and this could be one of the most important data sets for this week because it's directly gauging the consumer. So 70 to 75% of the economic data or the economy is from people spending money. We are expecting a good number. Last month was 0.3%. We are expecting 0.5%. So the higher, the better, really, when it comes to personal spending. That would show the consumers holding in there. The economy is continuing, to do fine. Walmart just reported earnings last week, and they said exactly that. The consumer's really not changing much. They're still weak in certain areas. They're stronger in other areas, and consumer activity has really not changed at all. Okay. So, I'm not expecting a disaster for personal spending. If anything, maybe we come in a little bit on the higher side, and that would be good news. Chicago PMI for August is expected to fall a little bit, and then we get final numbers from Michigan consumer sentiment. So it really is a jam-packed week this week as far as economic data. Besides Monday, to a lesser extent, tomorrow, not going to be any real big data. And then Wednesday, we don't get any real big data. But Tuesday, Thursday, and Friday, definitely going to be important days for markets. Now, before we get into your earnings, I do want you guys to listen to this clip from Tom Lee.
A record high following Fed Chair Jay Powell's remarks this hour, signaling a policy adjustment. Joining us here to unpack what we just heard, Tom Lee, head of research at Fundstrat, chief investment officer of Fundstrat Capital. Good day to be a bull like yourself, Tom.
Yes, it is.
How do you process what we just heard?
Well, I think that it's the Fed acknowledging that the risks now are tilted for the labor market to be softening, and they want to head that off, especially because they don't think that tight labor markets are going to necessarily create inflation. That's a very good sign, and I think it means we have a dovish Fed again, and that's kind of a green light for small caps.
Small caps
and for equities.
They are working. Last I looked, small caps were up 3%. So is this what we need to really confirm the sort of broadening that comes and goes in the market?
Yeah, because I think that one of the things we should watch for is what happens to mortgage rates. But mortgage spreads are right now 360 basis points higher than the 10-year. Historically, it's 1.6 percentage points. So you could see a huge drop in mortgage rates. That's going to help housing, helps the financial small caps. And I think already the ISM, which has been below 50 for almost 30 months now, could finally go back above 50, and that's a good sign for industrials.
Although we had a discussion right on the heels of the speech about a little steepening in the curve. Is there a sense that the vigilantes are at least present, if not being necessarily vocal?
But we could also be steepening because growth expectations are improving as well. So this could be like what I'd call a bull steepening. I'm not really sure what the fixed income terms are, but I think it's actually a positive sign for growth.
The only real losers today are going to be some of the yielders and some staples. Would you be cautious on those?
That's right. I think that markets have been holding their breath. They've been getting defensive. That's why we've been bleeding for 5 days. And so now I think there's a relief and some capital gets put to work, and it's good for equities and risk assets.
So, all right, we need to make some news here, Tom. Everyone listens to you. We're at record highs now for the S&P and the Dow. How much more can these stocks rally?
I think there's a lot of upside. especially because, once you get an ISM back above 50, it really does argue for a broadening of markets. And I think one of the leaders probably comes from the financial sector. So I think, towards the end of the year, 6,800, 7,000 is possible.
Led by tech still?
Yeah, so I think you still want to play
this week.
Yeah, you want to be long AI and the crypto trade because those have been the market leaders. So the Mag 7, Bitcoin, Ethereum. But the broadening is really the financials, industrials, and small caps.
So you like them all?
Yeah, it's kind of cyclicals, AI and crypto, but not the defensives.
Your crypto calls have been getting a lot of attention lately, especially on Ether.
Yes.
Where we were talking earlier, we were debating whether it's the future of the financial system. A lot of people are thinking, people like you have said that.
Yeah, I mean, I think it's a really important moment happening this year with, the Genius Act, really greenlighting stable coins, and then Project Crypto, which is Wall Street moving on to the blockchain. I think it's a lot like 1971 when the US dollar went off the gold standard. That created the innovation of Wall Street because they had to sort of essentially create this synthetic dollar. Wall Street moving on to the blockchain is a bigger moment, and I think that's why Ethereum is essentially having its 1971 moment equivalent.
But a lot of people just see it as wild speculation and froth.
I'd say anytime something goes up, people tend to call it froth. I think they called AI a frothy trade now, but we know it has a lot of legs, and it's been taking place for a couple years. Keep in mind, Ethereum is also the place where when agentic AI comes together, when you have robots and you want proof of human, you want to make sure those commands come from, a verified source. That's all taking place on a smart contract. A lot of it will be Ethereum.
Tom, thank you. We just scratched the surface on that one, but we'll have you back very soon, no doubt. Tom Lee.
Now, that's actually funny that Tom Lee says there's a lot of upside for this market, that 6,800 or 680 on the SPY roughly to 700 on the SPY is in the cards for the end of this year. Since frickin' May, I've been calling for the S&P to hit 700 by the end of this year. That is still my call. So, I mean, from here, it doesn't sound as crazy as it did then. When I first made this call, it was like a 25% rally, okay? But still, even from today's levels, that's like an 8.5% rally in the S&P. If that's not led by Mag 7, that could be a huge broadening in the markets, okay? Like if Mag 7 kind of doesn't do much, maybe they go up a little bit, but like isn't the main driver of that move. 8.5% led by small caps, financials, cyclicals, if you will, could be a massive broadening of this market. Now, surprisingly, this week is actually a big week as far as earnings as well. Monday, you have Semtech, but that's pretty much it. Tuesday, BMO, Scotiabank, some others pre-market. Tuesday and after hours, Okta, MongoDB, Box, PVH, Joy. Wednesday pre-market, Kohl's, Abercrombie & Fitch, JM Smucker, Williams Sonoma, RBC. Wednesday and after hours, the big dog, NVIDIA. NVIDIA obviously is important. We don't even really need to go over why that is. But as long as NVIDIA, does well, markets are going to do well. Okay. And there's no signs that NVIDIA should do bad, but expectations are typically always high for NVIDIA. So even if they do really good, I wouldn't be shocked to see the stock still come down a little bit. Snowflake, CrowdStrike, HP, Viva, Urban Outfitters, Five Below, Pure Storage, and NetApp report Wednesday and after hours as well. Thursday pre-market, Dollar General, Best Buy, TD Bank, Bath & Body Works, Burlington, Dick's Sporting Goods, Ollie's. And then Thursday and after hours, Marvell, Dell, Ulta, Centennial One, Affirm, Gap, Ambarella, Elastic, and Petco. And then Friday pre-market, you have Frontline as well as Alibaba. So yeah, this week is going to be absolutely critical. As we seen on Friday, stocks hit a new all-time high. And I think there was a lot of people that were super bearish heading into the Fed that had a lot of short positions that were negatively exposed to equities. We'll see how much of that short covering does continue into tomorrow, but honestly, I wouldn't be surprised to see a strong week this week. I think we're going to get a really strong week this week, in fact. Like, do not be shocked at all, especially if small caps and higher beta names, more risk on names do accelerate higher from here. Like you should be kind of prepared for that in a way. Because again, the Fed just greenlit the markets. I mean, this is like the 2022 equivalent of Jackson Hole. 2022 was the bearish Jackson Hole. 2025 was the bullish Jackson Hole. And this is a moment, a defining pivot from the Fed that is going to be looked back on in 2 to 3 years as the light bulb moment. We should have been bullish. And I think a lot of people are going to associate that with this time and get bullish on markets quickly. Okay, especially since we just had a 4% drawdown on the triple Qs. And then, now we're heading back up again. Wall Street, believe it or not, looks at this, fall and they say, wow, this is a great opportunity. Whether you believe that or not, a lot of us bought during the April crash. Markets are still up a lot, but Wall Street's really not thinking about that anymore. They're thinking about, how can we get another, 2, 3, 4% discount compared to where the markets are today. Okay. Or where the markets were at an all-time high. And they just got that. So wouldn't be surprised to see a strong week nonetheless for this upcoming week. Let me know your thoughts on all of this down below in the comment section. Hit that like button as well as subscribe to the channel if you have not done so already. Ladies and gentlemen, have a great rest of your day, and I will see you in the next one.